Hi, this is Jeffrey Cohen. I'm here to talk about negative beta stocks, how to trade them, what they are, what the actual stocks are, how to calculate it for yourself, and more importantly, how to think about hedging your portfolio using negative beta stocks. So the first thing I'm going to do is show you where to find the list. The list is at chicagoquantum.com, negative-beta-stocks, HTML. And the way you would find it is you come to our website. Usually just come to Chicago Quantum, go to Market Questions and Data, Negative Beta Stocks. So here you go. This list is accurate current as of April 1st, which was last Friday, market close. And it goes back a year. So what is beta? So beta is the covariance of a stock versus the index. So that's kind of complicated. So really beta is how much a stock moves when an index like the S&P 500 moves. It's a relative amount. So I've got some pictures I found on the internet. So beta is the slope of the line that if the market changes a certain amount, like the S&P 500 today went up 0.86%, how much did the shares go up? And this is over a year. So you're looking at a pretty certain 1 year number. So if a stock, let's say the market goes up this amount in the center, a beta of 0.5 moves less, half as much. A beta of 2.0 moves twice as much. Now a negative beta, that seems weird. That means that it moves in the opposite direction. So a negative 1 would be going down the other way. So the index goes up 1%, your negative beta stock goes down 1%. So why would you do that? Well, if you thought the stock market was going to go up a lot, you would never want to hold a negative beta stock because you would just lose money. But if you thought the market was going to go down or crash, fall 40%, a negative beta stock should go up while the market falls. That's the theory. It's a way to hedge stock market investments. Another way to interpret beta, here's another one. I really like this picture. If the market kind of squiggles around here, then the stock is going to squiggle. It's not an exact match, but over time, the amplitude, if beta is 1, is about the same. So if the stock market goes up and down, 0.5% a day, beta of 1 means it's going to move about 1. So a beta of 1 is average, it's normal. It's if you had every stock in the stock market and the index was appropriately measured, your beta would be 1. We find that when we run our model, betas come in at about 1.1, even 1.2, because typically once we validate the stocks, we take out the dogs, we take out the ones that go bankrupt, that don't trade anymore. We take out stocks that are not liquid. And they're good, kind of healthy stocks left in our model. So maybe a beta of 1.1 or 1.2. It wouldn't be complete if I didn't take you to Wikipedia. This will be fast. In finance, beta is how an individual asset moves, on average, when the overall stock market increases or decreases. And the math is this. Beta sub I got to show it to you because it's... all my math friends would be mad at me if I didn't show it to you. Beta sub I, so beta of an individual stock, like as an example, if you cheated and looked over to the side, TDW or Tidewater, right, is the covariance of that one stock, of the covariance of the returns of that stock each day compared to the returns of some market index. We use the S&P 500. We actually use SPY, which is an ETF. And you divide that by the variance of the returns each day of the market. So variance of the individual stock changes each day compared to the change in the market each day over the variance of that stock. So we do that in Python and we calculate that all out. And so our model has that. It's great. It works. We get beta. We've been getting beta since the very beginning, and this is actually how we figure out the expected return of a stock. So now I want to show you what this means in real life. So, by the way, yes, I have $100,000 invested in the stock market. I really do believe. Now I want to show you what high beta stocks that our model has chosen, what they do. Okay? So the S&P 500 today went up about 1%, a little less than 1%. It wasn't a bad day. The stock market traded about half the volume. And if you look, though, down this list, most of these percentage changes for the day are above 1. In fact, if I were to click it this way, you can see there was one almost 10%, 9, 7, 7, 5, 5, 5, 4, 4, 4, 3, 3, 3. I mean, there was two that were tiny and one that was negative. So if you think the market's going to go up and you want to invest in a high beta stock, then when the market goes up 1%, your stocks might go up 9%, which is terrific, right? Love it. If the market goes up every day, you're in high beta stocks, you make money every day. A negative beta stock is a bet against the direction of the market. And so now let's take a look at those stocks. So I have them, of course, on the website, but I'm actually going to show them to you in an Excel spreadsheet because it's kind of nice. But I will start just by giving you one little caveat. So what I just gave you made it sound like negative beta stocks are the way to hedge. And in fact, it's a simplification. It's not really true. So there are stocks with a beta close to 0, and a beta of about 0 means that no matter what happens to the S&P 500, the stock will move independently. So a good example, again on the website, is TVC. It's a $25 bond that you can buy. It trades like a stock on the stock market. It's a $25 bond issued by the Tennessee Valley Authority. Well, guess what? The beta is near 0 because it actually moves based on the interest rates and the health of the company, not the stock market. And then other examples are anomalies. I call them meme stocks. So negative beta could be caused by an anomalous trading activity. By the way, not seeing as many of those in the data right now. In fact, I'm really surprised. I don't see any memed stocks in the negative beta list. So this might mean that the meme movement where groups of people go in and just bid up and down stocks randomly, I'm not seeing it in the data. It could be poor business performance during a rising market, or exceptionally good business performance during a declining market, or it's a counter-cyclical stock. So this is what you're counting on. If you want to find a stock with negative beta that is truly counter-cyclical, that's the way to hedge. So let's get in there and let's find you a few that you might want to trade or you might be excited about. And so I'm going to get everything out of the way and I'm going to show it to you. Let's make this list huge for you. So we're going to start at the bottom. So the first thing to know is the US dollar index. So the US dollar has a negative beta to the stock market. So the way you would look at that is either a strong stock market a strong dollar is bad for the stock market, which may be true. These are US listed companies. When the dollar is strong, it's hard to export product to other countries because you bill in dollars. Dollar strong, hard for other countries to afford your products. So it gets a little tricky. The other, which you would expect, is gold. Physical gold has a negative beta. So think about it. When you're worried that the world is coming to an end, that Russia is invading Ukraine, that everything's going to crash, right? Your mother-in-law is going to move in with you. That's when you hold physical gold. So that has a negative beta of 8%. So what that means is it's a small hedge, but it's a good hedge that makes sense. So When the market crashes, gold goes up. You hear about it. Oh, gold hit 2,000 today because everyone's worried about COVID. Great. You're also going to find other gold stocks in here, gold miners. It's very important. So Newmont Corporation is the largest gold mining company in the world, and they have a negative 12%. Why is it more than gold of 8%? Because Newmont Mining doesn't just have the value of the gold, but you're buying the future value of all the gold that they're going to produce minus the cost of that gold. So if gold goes up $1, they're basically making an extra $1 of profit on every ounce of gold that they will produce forever. That's great. That's why gold is a good hedge, and that's why it makes sense to see Newmont Mining in there, Newmont Corp. By the way, I've looked at NEM. I would buy it. It's a good stock. It's an interesting stock. You also see Barrick Gold. Barrick Gold trades at a negative beta, so to speak, of 0. And that's because it's not as effective of a miner as Newmont. It's not as efficient. So it's independent of the market. It's not really a hedge. It's independent. So now let's look at what else you see. So Chesapeake Utilities, I think, is an anomaly in the list. So 9 Energy Service Inc., IHS Holding, China Shanghai Food Company, Bellring Brands, Green Giant. So this is tricky because there's food companies, and so if the stock market were to go down, maybe they're selling food that's like a Geffen good. That's food that people buy, like pasta, when they're poor. Could be that. I'm not really sure. Like, these don't make sense. These have just kind of shown up in the list. But so 9 Energy, IHS Holding, we've talked about these. So Fathom Digital Manufacturing Corp, my guess, FATH, is that's one of those that maybe didn't do so well in a rising market. Same with NTIC, Northern Technologies. There's an SES AI Corporation, Kinetic, spelled wrong, Kinetic Holdings, Logic Mark. So maybe those... those are the anomalies, right? Maybe those are memes. Don't know. And then you see some financial services companies in there. Now, this is interesting because when interest rates go up, the stock market goes down. So interest rates up, stock market down. Inflation goes up, stock market goes down. Well, who benefits when interest rates go up? Well, in many cases, the banks. And there's not the big banks. It's not Citibank, right? It's small banks, because these small banks may have a portfolio of loans that are variable rate, that go up with interest rates. And so their risk is already set. And if a 1% rise in the Fed funds rate turns into a 1% rise in all of their loans, in the money they get paid, oh, that's terrific. So let's take a look at how many of these financial services companies there are. I'm betting there's a few. So we're going to color those green for money. So I've got Nicholas Financial. I'm not sure if Tidewater might be a bank. ESSA, Bancorp. These are making sense to me. Union Bank shares. Codoris Valley Bank Corp. All right, it's interesting. Chemung Financial Corp. Right. Citizens Holding. I bet you that's Citizens Bank Corp. And there's others. There's First Savings, Landmark Bank Corp, California Bank Corp. All right, Jeff, we get the picture. So banks. So not bad. Small banks. Small banks can be pretty safe if you understand the risks that they're taking in the portfolio. Always a risk with these little banks is if they're lending money, let's say, to Bitcoin miners, and Bitcoin crashes, well, they're not going to get paid. If they're lending money to energy companies and energy crashes, they're not going to get paid. So you want to make sure they're lending to sure things or things that are not so sensitive to the economy, like maybe housing. Maybe they're residential home lenders. And as a result, in their particular towns, the house prices are going up. And then you have some other stocks that are just moving really independently of the market. You got some oil here, right? Maybe they went up when oil went up, and because oil went up so quickly, the market had fallen. So when oil goes up to $100 a barrel, it is not good for the stock market. It's especially not good for trucking stocks. Not that I want to talk about trucking stocks, but I'm going to show you a chart of trucking companies that I follow because they're crashing. And the reason they're crashing is because the price of oil has gone up. And so, you see that right there? Great day in the stock market. Stock market went up. These are not risk-free stocks. They all went down. They've been down for a week, right? Trucking hates oil prices going up. So let's go back to our negative betas. Battalion Oil Corp, Ranger Energy, right? You've got some oil companies in there, right? And maybe they're doing well when the market does not. It's possible they have a lot of exposure, right? They haven't hedged out the oil prices. And then the rest of these are very minor negative beta stocks. So you're just looking at those over time. So to conclude, we see gold as a hedge against inflation. We see gold with a negative beta. That makes all the sense in the world to us. Newmont Mining, great stock, great company, profitable, right? And they're very large and they're very efficient. So that's a good way to bet against and hedge your risk in the market. You got your small banks, right? Maybe they've got loan portfolios that benefit. And then you have a bunch of other stocks, and you really have to look and see, are these like golden goose laying golden eggs? Are they memed? So they're anomalous trading history? Are they just terribly run companies that have lost money during a rising market? That's where your due diligence has to come in. So we publish this list on our website about once every 2 weeks. And if you ever have any questions, I would like you to know that you can just pick up the phone and call me. I am old-fashioned that way. So give me a call. Shoot me an email. I'm going to show you how to find our information. And just get in touch. Because this is what I do for a living. So I'd like you to. So you come to our website, chicagoquantum.com. You can look at the contact button. Oh, there's me. I'm Jeffrey Cohen, by the way. That's really me. Here's my cell phone, personal cell phone and work cell phone. Here's my email. Here's my address. If you'd like to follow me on Twitter, I tweet like crazy. I love tweeting. I have like over 2,000 followers, and I follow 2,000 people. I learned a ton from financial Twitter. And again, if you just want to find it, go to Market Questions, Negative Beta Stocks, check it out. So, hope you found it helpful. Thank you very much for listening. Take care, and good luck in the markets. Bye-bye now.